Everyone, welcome back to the 7-Minute Takeover Mythbusters edition today. I'm Liz.
And I'm Eamonn.
Today, we are tearing down a big myth in business acquisitions, the idea that lenders are obsessed with loan to value, or LTV, like it's a real estate deal. Eamonn, why do so many buyers think LTV is the key to getting a loan? And for those new to LTV, what is it?
Great question, Liz. So I think the most common way that individuals interact with the banking system in Canada is in the real estate market, as you mentioned. They're used to buying a house and knowing that if they get an appraisal, they can put 20% down or 10% down if it's insured and get the rest as a loan. It's really that loan to value that's the number one metric that real estate lenders look at. But they don't necessarily operate in the same way, the banks that is, when it comes to business loans. And that's because business valuations can vary dramatically in terms of its relation to cash flow, and ultimately it's cash flow that's going to repay their loans. So that's where their focus really is.
Gotcha. Okay, love it. So like the old saying goes, cash is king.
You got it.
And many buyers are out there comparing shiny valuations, but lenders are like, just show me the money. Where's the money coming from? How much is there? So if the lender is actually looking at cash flow, I believe you're speaking about the term debt to EBITDA, which sounds technical. So break it down for us, Eamonn. What is debt to EBITDA and why do lenders care about it?
Yeah, this ratio can take a few different forms in different industries. You might have debt to free cash flow in oil and gas, or debt to net operating income for real estate. The most common measure is debt to EBITDA. It's really just a measure of how much debt is outstanding relative to the amount of money that the company brings in a year. So EBITDA being earnings before interest, taxes, depreciation, and amortization is a measure of cash flow that's supposed to be a little bit steadier year over year than net income. Lenders use this ratio to figure out how much debt a business can really handle. So for example, if you have a company that has EBITDA of $1 million and the lender is okay with a 2.5 times debt to EBITDA ratio, they might lend up to $2.5 million. You see how nothing that I talked about in that formula related at all to the valuation of the company and how much you're going to actually pay for it.
Mm-hmm. Okay, that makes sense. It's like a stress test for the business's profits. But what's you mentioned 2.5 times EBITDA, but what is a typical debt to EBITDA range that buyers should be aware of?
Good question. So again, the lower ratios that a bank might be comfortable with might be for a company that's a little bit more volatile in its earnings, may have less defensibility to competitors or not be in a strong negotiating position. In those cases, you might see debt to EBITDA closer to 2 times, maybe even a little bit less. But if you've got a nice steady business, good recurring revenue, and all the other things that make for a really strong valued company, they may be more comfortable at the 3 or 3.5 times. So you could have in that $1 million scenario, depending on the rest of the features of the company, comfort from kind of 1.5 to $4 million.
Okay, gotcha. So cash flow rules, debt to EBITDA is the magic number, but back to the loan to value figure as well. Don't lenders care about how much equity the buyer's bringing to the table, how much capital they're coming in with?
Yeah, they do. And debt to equity is the ratio that they'd use in that scenario. So again, they have to do some quick math when you start talking to them in terms of loan to value to convert it to their common metric, debt to equity. What that does for them is just ensures that if there are 1 or 2 years of weaker earnings, that there's an equity buffer to absorb some of those losses before it really starts to require additional debt or equity financing to keep the business afloat. So it's more of a skin in the game and a safety net that the lenders are looking at when it comes to debt to equity ratios.
And how much do they typically want to see in from the buyer if you had to say a number?
Usually it'd be about minimum of 10 to 20% buyer equity, and you can supplement that sometimes with vendor take-back notes or seller financing. But a minimum, the maximum debt to equity ratio that they're comfortable with is in the 4 to 5 range.
Okay, gotcha. So here's where buyers trip up. What happens when they're dreaming of a high loan to value, but the lenders are like, nope, the cash flow is too weak? What happens there?
Yeah, it can be a rude awakening. Really, you want to have that sense of if you're going to be able to get a deal done before you put an offer out. So if you can imagine a buyer looking at a $10 million business, they start thinking about loan to value. They think they can put down $2 million, get $8 million as debt. Lender checks the financials and sees historical EBITDA is less than $1 million. Maybe they're only eligible for $2.5 million of debt financing, regardless of the fact that would be a tiny debt to or loan to value ratio. That's just all the lender can support in that situation.
Okay. So it seems like the lenders are a little bit like detectives about where the cash flow, how stable it is, and what those figures look like.
Well, when you think about it from their perspective, they're typically giving out about 7-year money, and we're expecting them to underwrite that with 3 years of financial statements. They are at a bit of an informational disadvantage. So, if you want to avoid that situation, really, you want to look for more than 3 years of financial statements, see how a business performs through a full economic cycle, and make sure you're running a competitive process when it comes to speaking with lenders to make sure that you're getting the best possible terms from a lending partner.
Awesome. Thanks, Eamonn. Solid advice. All right, everyone. The myth is busted. Loan to value isn't the star. Cash flow and debt to EBITDA are where you want to focus. And you'll be ready to talk to lenders like a pro. Eamonn, always a blast crushing these myths with you.
We'll see you next time.
Thanks, everybody. Take care.